Okay, welcome everybody. My name is Tiffany Bauer. Once again, I'm the Program Director for the National Cleantech Conference, which is taking place in Brisbane in March 2021. Just before we do get started, some quick housekeeping. This session will be recorded and the recording will be uploaded post-event and distributed to everyone who's registered. We welcome questions. We actively encourage them. It really makes these conversations interesting and engaging. So these can be entered into the Q&A section by clicking on the icon at the bottom of your screen. We do ask that you put questions into the Q&A box as opposed to the chat. That way we can ensure that they're answered by the panel. We will endeavour to answer all of these throughout the session. If there are any that we don't get to, we will follow up with these post-event. We will be running a live poll today as well. This will come up on your screen during the session. You'll have about 20 seconds to answer and the results will be available immediately. This session will run for approximately 45 minutes with some additional time for Q&A, but we will be aiming to wrap up at 1:30. So today we are discussing funding cleantech startups from the startup, accelerator and venture capital perspectives. This webinar is supported by an NCTCE event supporter, Energy Lab, who are Australia's largest cleantech startup accelerator and network dedicated to the clean energy transition. They connect founders to the mentors, advisors, partners, peers and investors that they need to succeed. We're very pleased to have CEO James Tilbury part of this conversation today. I'd like to introduce our panel facilitator, Paul Halvell, who is the Managing Consultant of Directional. Paul works as a mentor, advisory board member and angel investor with clever clean energy companies that accelerate the world's transition to renewable energy and help combat climate change. He takes an active role with teams that he works with focused on business strategy, raising capital, sales strategy and execution, and alliance strategy and execution also. He has mentored teams on the CSIRO's ON program, Energy Lab and other accelerators since 2016. Previously, Paul has been a co-founder and on the management teams of 4 startup early stage tech businesses, which have successfully scaled and or exited. So I'd like to hand over to Paul, who will be moderating this session, and Paul will introduce all of the panelists who you'll be hearing from today. So Paul, if you can take it away.
Thank you very much, Tiffany, and thank you to all of you who have joined us on this afternoon's webinar. Let me do as Tiffany suggested and kick off by introducing our panel. So joining us from a startup called MGA Thermal is Professor Eric Kesey, who's the CEO of that clean energy startup. Eric has had 30 plus years of academic and research experience in materials science and is the co-founder and co-inventor of a very clever piece of thermal energy storage technology that is commercialized under the company MGA. MGA went through a startup program sponsored by the CSIRO ON program, during which he and his team validated the commercial viability of the MGA technology and subsequently span it out. And what's particularly relevant to today's conversation is that Eric's team was successful in raising a venture capital seed round earlier this year, and more recently also an accelerating commercialization grant from the Federal Department of Industry. That takes us nicely to David Burt, who in Eric's days of the ON program was the then head of the CSIRO ON program and indeed one of its co-founders. David is now the Director of Entrepreneurship at the University of New South Wales with a focus particularly on doing much the same, helping clever technology organisations with a particular focus obviously on Uni of New South Wales look to commercialise their technology. Rachel Yang joins us from Giant Leap, which is the venture capital arm of the Impact Investment Group, who is here to give a perspective on the venture capital view of investing in clean tech startups. And James Tilbury, as Tiffany's just touched on, is a stalwart of the clean tech energy. He's the co-founder and CEO of Energy Lab, with whom I've also mentored for the last 4 years, along with mentoring with David on the ON program. So thank you all for joining us today. The focus of today is very much around funding for cleantech startups. So I'd just like to kick off, if I may, just by putting a little bit of context in there that was part of the webinar invitation, and then fairly quickly introducing NGA's technology via a video and using that effectively as a starting point for our conversation. Because cleantech startups can find it tough to raise capital in Australia. They often involve commercializing quite innovative technology that often also has complex R&D, sometimes hardware as well as software. Sometimes there's prototypes and pilot projects, which are also required. These aspects take time. These components add a little bit of complexity to the route to market, and MGA is a classic example of all of these aspects. And it's partly because of that that many of the venture capitalist industry have traditionally been a little bit cautious, because they look at hardware, they look at complex R&D, they look at the whole area of deep tech spin-outs as being a little bit tricky to understand. So the focus of this is really understanding that. So as I say, to kick this off, I'd like to introduce MGA's technology via a 2-minute video. So I'll hand back to Tiffany just to play that video to explain the background. Thank you, Tiffany. What a great video. I look at that video and each time I look at it, I think, geez, that is just compelling technology. You've got the potential to repurpose every fossil fuel power station on the planet into a big renewable energy battery, basically. Eric, if I may, I'd just like you to share a little bit more background around MGA as a startup, your progress to date, and perhaps touch on some of the key successes to your funding of such an innovative technology.
Okay, I'll try and cut a long story down a little bit, but in 2011 we invented a new class of materials to store thermal energy, and the university patented them the following year. Then it followed 4 years of development, but basically thinking that someone was going to knock on the door and take this technology forward. And then we realized that we had to do it ourselves. So that's what we did. So very ably assisted by the ON program. We learned that what looks like a product in the university lab doesn't necessarily look like a product on the street. And also to shift our focus to customers and markets, and learned a lot about the mechanics of startup life. So we founded in 2019 in April, while we were still doing the Accelerator program. We secured an exclusive IP license from the university in September of last year. And we also signed a development contract with the Swiss company E2S Power in the following day, in fact. And that funds our further developments for integration into a product that they're developing for retrofit into power stations. More recently, we've had a small seed round in more or less signed off early this year, but because of various factors, completed in June of this year, and our accelerating commercialisation funding, which is matched to the seed round, commenced on the 1st of July. Now that round of funding is to, as Paul was saying, we need to manufacture, so we need equipment, premises, etc. So that round of funding provides money to build a manufacturing plant to demonstrate scale up of the production of these blocks, and also semi-automation of their production. It also funds some business developments to fill some gaps in the team. Next steps for us are we've got ongoing discussions with energy utilities, a couple of them coming up in very shortly. Some of these utilities are among the top 3 energy companies in the world. So we're going straight for the big end of town. We're not mucking around building a little widget and then trying to scale that up and sell it to our neighbours and then bootstrap ourselves. We've attacked the largest market possible for our product. And I guess the successes are, or the reasons for success, I guess, we've got a good product. It's timely. Everybody's desperate for energy storage right now.
Yeah.
It's adaptable to many markets. And what's worked for us is to be focused on that product, and to continue to build off the contract that we have with the Swiss company. So that was a real game changer for us.
Yeah, yeah, indeed. David, MG and Eric's team were one of the standout teams, albeit among many, of successes through your time running CSIRO's ON program. What's your perspective on why venture capitalists should look particularly for clean tech startups in Australia?
Yeah, thanks. No, definitely MGA team, great example of, multi-year research project inside a university, showing what's possible, kind of pushing out the frontier of what's possible. And then a great investor matched with a really good funding scheme and accelerating commercialization, sort of breathing life into that company. I think the other thing to emphasize is you actually have the inventors of that technology going with the startup as part of the founding team.
Yes.
So I think that would be my first tip for any investor who's looking at a clean energy startup, especially one that's got some sort of, I guess, proprietary technology as part of what it's advocating its value proposition is. Unless the people that actually have the capability to sort of wiggle that technology in the market are in the founding team, I personally wouldn't suggest you invest in those companies. And so I think that's sort of relatively new in Australia. It's a new trend in the clean tech sector. I think the other thing is just there's a couple of other trends that I think investors who are interested in clean tech can tap into. Because I think if you're thinking about investing in clean tech, you kind of have to ask what's different. Because if you look at 2006 to 2016, most of the money that went into clean tech went to zero. So you got to look at that and go, well, about $12-13 billion that was invested into clean tech over that decade went to zero. So what's different this time, or what might be different this time? And I think there's three trends that are making it easier for startups like MGA Thermal to emerge and raise funding successfully. Really, that comes down to what the market's doing, what the capital intensity is doing of some of these business models, and the pretty poor returns for other asset classes at the moment relative to what's going on. So in terms of what the market's doing, I think by market, I mean regulator, and that's where I think most Cleantech version 1 VCs went wrong. They weren't really used to dealing with regulators, and what the regulators decide and the settings that they put around the market, that's going to determine the market timing and the profitability for a lot of these early stage companies. So I think the market is heading in a much better direction. There's a lot more space in the policy narrative for renewable energy, more sustainable power systems. So the market pull or the market demand, which is actually a function of the regulatory environment, is a lot better than it was in the past. Whether it's good enough to make big bets in the space, investors have to form their own thesis. In terms of the capital intensity, that's also something we're seeing come down, both on the install side. So in terms of as the actual installations of Cleantech go up, sort of the per gigawatt cost of that, or however you want to measure that, goes down. So these things are capital intense. That's also what version 1 of Cleantech VC got really wrong. They weren't used to dealing with non-sales capital intensity for growing companies. So that's still a factor here. But I think that trend is going in the right direction. These companies are still more capital intensive than a software startup. They kind of look more like a biotech in that sense. And then the third trend is, cash is hunting for a return. There's lots of money out there. I've been personally surprised by how easy it is for startups to raise at the moment. I've been advising a few founders that have raised quite easily, and the rounds were oversubscribed. So I think those are the three trends around what the market/regulator is doing. The capital intensity of many of these startups is going in the right direction, i.e. down. And there's just a lot of money looking for a home. So it's a good time to be someone like Eric. Yeah, great comments, David. I'm going to open with Rachel with one of the first questions that's come in here from Prem Sundaram, which I think is targeted primarily at MGA, but I'd love a VC's perspective on this, Rachel. So the question is, was it critical to success to get funding to have the patent and the validation of the Swiss customer, or was it more important having the people on the team? I know that's targeted at Eric, but what's your perspective? The patent, an initial flagship, core customer, or the team, Rachel?
Yeah, it's interesting. It depends on the mandate of the fund, but from a Giant Leap's perspective, we definitely see the team being a huge component of the success of any business, and that being really key to the growth. And so what David was saying about ensuring that the creator and the researcher that's behind the tech being on the team, I think is really important to understand from the earlier stages. What they can do to adapt the product and grow the opportunity there. I think from a patent perspective, there's a bit of a mix. It's basically about de-risking. So we do consider patents, but it depends on, whether or not there's some things that aren't going to be patented, and there's just secret sauce in the background that actually makes it, lower risk to be kind of taken and adopted by someone else. And so those key elements are critical, but then the revenue part for us as Giant Leap, we need to see at least $1 of revenue in the core product or service before we invest. So I think I wouldn't be able to rank all of those, because in our mandate, we actually need all three. The patent, I guess, is probably lower down the list because of what I spoke about before. But that's not to say all VCs are the same or all investors have the same kind of mandate.
Just to wrap up on that question, let me throw it to Eric, if I may, on your perspective with your particular VC. How would you rate your understanding of their priority around patent versus team versus the E2S customer relationship that you already had in place?
They're very interested in making sure the IP is secure. So the patent is good. Sorry, I've lost sight of the question now. It's gone.
The ranking of the patent, the team, and the E2S or the established existing customer opportunity.
As Rachel said, they're all important. They all tick a different box, and they're probably 3 of the top 4 for every single VC, and are just placed in a slightly different position on that list for each VC. But nobody wants to invest in something where the IP isn't secure. And I think David's point is excellent. If the founders don't have a deep understanding of the technology, then the adaptability of the company is poor. And that's what you need in a startup. You need to be agile.
You do indeed. James, great question for you, given that you've been running Energy Lab now for, 4 years, and you've had quite a few hundred clean energy startups through the doors there. A question from Anonymous. Cleantech's a global game, so would appreciate a discussion around what unfair advantages an Australian cleantech startup has relative to other geographies.
Yeah, it's a good question. And it's something that we think about quite a lot in assessing international applicants to our programs. And what they're telling us is that Australia is leading the game when it comes to energy transition in not all aspects, but in many aspects that are relevant to their businesses. And so while Australia might not be the biggest market in the world, it's a great place to try out new technologies before they might become viable in other jurisdictions. And this is a function of a number of things that we could go into, but our rooftop solar penetration, the way our energy market is structured, and kind of the function of the NEM, kind of how that runs, and also some progressive regulations we're bringing in, such as allowing different market participants. So there's a lot that, particularly in the clean energy space, which is our focus within Cleantech more broadly, there's a lot that you can do in Australia, test out here before targeting larger markets such as the US, Asia and Europe.
Yeah. Anything to add on that from a VC's perspective, Rachel?
No, I think James has really covered. I think one thing to think about is just the impacts of climate change in Australia. We saw the bushfires and I guess the challenges that Australia faces with our climate can actually push for greater innovation in some ways, really making the problem really kind of at the forefront to help with that innovation. So I think there's a lot of activity, which means that then there's greater innovation across the board and potential for innovation. So, and we've got some great research institutes as well. So I think all of those things combined have a really wonderful potential for growth.
Yeah. Back to David. You touched a little bit on the trends that have occurred around venture capital over this last decade or so. How do you think that prospect is likely to evolve, the opportunity for raising capital into the future? I was refreshed by your comment about being relatively easy, able to raise some seed for some existing teams that you're working with. What's your thought particularly about the sort of next stage, the Series A type size of investment?
So I think I mostly play at the seed stage, so pre-revenue or very early like pilot revenue for companies. So, Series A, not so much, although there is, one company I've been across that did do a really healthy Series A in the last couple of weeks. That was a software company, though not a clean tech one. So I think in terms of like where we might be going, I think at the moment what's holding up a lot of investor interest in the asset class of early stage companies is just a lot of cash around. If you look at some of the disclosures by the banks around cash deposits, just globally, they're higher than this time last year. So there's actually a lot of cash, and that's a function of government stimulus and what the US Fed's doing to kind of prop up asset prices. So as long as that remains, there should be a healthy allocation by LPs for the asset class of venture and early stage. And again, I think then it's up to VCs to be able to have leading conversations with the source of the LPs around, okay, here's why we think this is the trend of where the energy market's going, right? In terms of what is the timeline of that transition to more renewable capacity, things like storage, all the ancillary value propositions that come with that. And I think for the Australian perspective as well, I think investors having a thesis around how does Australia participate in the global energy economy? because the domestic energy market is actually big enough to sustain some really interesting high growth companies. And so if you want to be an investor with a thesis that's focused on renewable energy in Australia, like, yes, it's a global market, but that's a big enough market to grow a really exciting, valuable company. Or do you think there's a startup that can service renewable energy markets in other parts of the world? Or do you think Australia is going to be a net energy exporter, whether that's through something like the Sun cable, piping something directly to Singapore, or whether it's some type of hydrogen or ammonia medium to kind of move energy around the world? Like, have a thesis on, will Australia play a meaningful role in sort of a net export of energy? Will Australia be a net exporter of energy? If so, that's the story you should be telling LPs right now. That's the 10-year bet. And I think the investors that can figure that out, have the discussion with LPs, now's the time to be locking in those funds.
It's a great comment, particularly in light of the recent articles, the recent announcements that have come out of places like SquarePeg and Blackbird about raising some pretty substantial funds with a focus on the sector, which is really, really exciting for us in the sector. I guess, though, I look at this and I look at Rachel coming from IIG and Giant Leap, which has a very strong impact orientation and clean energy orientation. You have your own renewable energy division as part of the business, which is fabulous. But you are still relatively unique. If I look across the whole portfolio of VCs out there operating in Australia, there aren't that many that have a particularly deep and long-standing understanding of the sector. There's a few, but not that many. And to some extent, it comes down to mandates and portfolio structures, the way in which VCs structure, the way they build their investment portfolios. What are your thoughts, Rachel, on how VCs should address that, how they might modify investment criteria to support a greater focus on this sector?
Yeah, it's a good question, because I think the way that the generalist VC funds are structured, that there is that diversity of sector focus to ensure that there's a mix in the portfolio to de-risk in some way, to not focus on one particular sector and therefore be able to make a lot of, generally a VC portfolio is around 20 to 25 investments. And so being able to spread that risk across sectors is what the previous thinking has been, and with the generalist funds and with our fund as well. Also being able to find the deal flow across those sectors, I think provides that mix and that spread, which is maybe why there haven't been to date as many clean tech focused funds, or they've been more sitting within government. You can look at something like Tenacious Ventures, which has now got investment from the CEFC. I think that funds like that have what narrower but also relatively broad focus can provide more capital to be able to help clean tech startups. But it is about that mandate and getting that diversification of risk, because I think one of the main things that leads to the success of any startup is timing. And I think to date, the timing potentially hasn't been quite right for clean tech startups to be able to see the opportunities for VCs from the VC perspective. And so with the changes that we've all mentioned, I think that there is opportunity now for those sectors, like David said, to provide that opportunity for growth within Australia and renewable energy and the clean tech sectors, to then think differently about how you might structure an investment mandate. But it has been about timing in the past. And I think now there's greater opportunity because of the increased focus on climate change. But it's certainly something that has taken a bit of time because of the traditional way of thinking with VC.
Yeah. Let me go to a question here from Kim Lawrence, which is an interesting one around generation technology and the applicability onshore or offshore in Australia or elsewhere. If developing a generation technology which has a market that is predominantly offshore of Australia, with relatively limited potential in Australia, what are the key issues that an Australian investor would consider? For example, is an offshore presence in one of the target markets critical when the technology is at that pilot stage. This relates in many ways to what Eric and MGA are going through. But what's your thoughts there, Rachel?
So is the question about what Australian investors are looking at from the perspective of having a presence here rather than overseas?
Yes, possibly the mixed presence, because obviously entering an overseas market is a reasonable investment. It's even more challenging right at the moment when you can't jump on a plane. But ultimately well, as David touched on, there's opportunity for some startups to scale to a degree in Australia, but we are still only 25 million people. And certainly MGA, Eric's business, has massive global potential but needs to act on that global potential. What are your thoughts about getting the balance right, potentially starting locally and going offshore, or whether the organization really needs to go offshore to get quick traction? What sort of flags does that raise in your collective minds?
So I think the way that we look at it is very much about a strategic go-to-market kind of approach that is not going to be one size fits all. So I wouldn't say, start in Australia and then go overseas, or start overseas in your target market and then come to Australia. I think it just is dependent on the type of business and the market opportunity. And again, going back to that timing of where the opportunity is to get that traction and prove out that product market fit. There's no point going overseas to where you think the market's going to be huge if they're not ready for the product, because ultimately you might not be able to get any traction over there, but that might not be a reason to shut it down entirely. There may be opportunity elsewhere. So it's just really understanding your target customer and market and where they're up to with the idea of buying whatever you're kind of selling. I should use an example. So we've got an investment in the US called Full Cycle Bioplastics. They're based out of San Francisco, and they turn organic waste into biodegradable and marine degradable plastic. And we see a global opportunity there, but they've started with a key customer in the US and have been talking to people overseas, but it's just been focusing on that pilot in the US. Now, we're Australian investors, but we saw the global opportunity there and the potential they could have for a positive impact in Australia. So we felt that was the right investment for us. So I think it's not a straightforward answer, because it depends on the business itself.
Yeah. Great question coming here, very topical right at the moment, the impact of the pandemic on clean tech investments here and globally. Is that changing VCs' thinking and creating a higher bar? Actually, before I ask once again Rachel for comment here, James, you obviously have a sister team in Boomerang Labs run by Anna Mins with a focus more broadly outside of clean energy but into plastics recycling and the circular economy. What's your perspective on the impact of the pandemic on investments across your various portfolios?
Thanks, Paul. I think clean tech startups are hit by the same factors as startups more generally, and I think investors, particularly thinking about angel investors who we have a lot of experience with, are a bit more risk adverse. So they're still investing, which is the good news. The bad news is they're a bit more reluctant to invest in companies that might have a bit more technology validation or market validation to go. But as far as it comes to clean tech, we're starting to see two different theories here. On the negative side, some investors starting to say, well, the only companies that are going to make the most money right now are going to be those who can ride this COVID wave. And so the obvious ones being platforms like Zoom that we're all on right now, investments that can take advantage of, we're going to use that phrase, of the pandemic, or at least kind of ride that wave, will be the ones they're going to focus on. Others are saying, well, governments are going to have to put a lot of money into the economy to recover. They also need to decarbonize and transition their economies. So they're probably going to do both at the same time, because that'll be the most efficient allocation of resources. So over the coming 5 years, we're going to see a lot of money and a lot of government push into decarbonisation, clean tech more broadly, and that's going to create opportunities for clean tech startups. So I guess it really depends on which camp the investor is in, whether clean tech startups are getting a warmer or colder reception from investors at the moment, as far as our experience has been.
Yeah. Eric, I might throw this international aspect to you for a quick comment, because your initial opportunity with E2S is based in Europe. Germany has made a federal mandate to rapidly phase out all fossil fuel power stations, which is obviously a huge statement on behalf of Europe at large and a huge opportunity for MGA. But obviously you're here in Newcastle in sunny New South Wales. So as you consider your next moves, as you consider expanding in Europe, and for that matter, the need to run a Series A and future capital raises for the organization to capitalize on these massive opportunities, what are your thoughts about the impact of going overseas, or the challenges that you're facing around that?
Well, the challenges are numerous. I mean, even down to weekly meetings with the team over there is very difficult not to be able to walk next door or pick up the phone and talk to someone in another Australian city. But putting aside those like very minor things, the opportunity in Germany is just too good to pass up, even though we're located over here. And that's where our initial funding came from. But in our case, we're lucky because our technology can be applied in almost every country across the world if the right investment and or policy decisions are made. So we're talking simultaneously to European utilities and also Australian utilities about where we're going. In terms of investment, likewise, we won't necessarily restrict ourselves to Australian investors. I think we're in a fortunate position. Some other types of technology may not be, but even outside of the power station opportunity, our technology has about another 6 different market segments that we could have gone for.
Yeah.
We chose this one because of the massive impact it can make, but also because, to be quite brutally honest, that's where the money came in first.
Well, and it's a massive sector in its own. The target addressable market is just huge. So, and it's eminently replicable. Do it for one, and it's applicable for all, which ticks so many boxes. David, I think I've got a question come in here that's got your name written all over it, albeit it's relevant to every member of the panel as well to some degree. It's speaking to the question about, for those clean tech startups outside of energy, examples being water, waste, agriculture, etc., where the returns may potentially be less, what's the impact on, or how do they go about attracting investment? Obviously, UNSW, you've got such a massive portfolio of clever stuff happening there. You'll have plenty in this space. What are your thoughts there? Yeah,
so I think the founders of those companies, need to be finding investors that are looking at the risk and return profile of those companies. So, yes. I think we've seen where founders go wrong is where they're working in a space that has a capital intensity to it, a real world hardware or physical component to the value proposition, to the product. And that means that the gross margin of those business models is going to be lower than software companies. And so I think it starts with the founders of those companies being ready to have the conversation with potential investors, which is the "Are you my investor?" conversation, as opposed to what accelerators usually teach founders, which is "Are you my customer?" conversation, which is that's the first thing to focus on. It's also super important for all founders to be able to have the "Are you investor?" conversation and to cycle through that as fast as possible, because there's just a whole class of investors which don't want to invest in those business models. And I think it's the duty of the founder to qualify potential investors and help them understand the scenario where everything goes well. This is what our business model looks like. This is what our margins will probably look like. Like, it's unit economics. And I think then it's really up to the founder to qualify if that's something that investor is comfortable with as sort of a risk to take on, because again, part of what often happens in due diligence is investors sort of ask all these questions around what might go wrong, why might this not work? I think it's the job of the founder to tell the story of, if everything goes well, here's what we look like in 2, 5, 10 years. And if the everything going well story doesn't provide enough of a return on investment in terms of what that business might be valued, then that's great. That's not the investor for that founder. But again, it's the founder's responsibility to qualify investors, just as much as it's the investor's responsibility to do due diligence on that company.
Yeah, yeah. I can't finish this question by not passing it to Rachel, because obviously Giant Leap and IIG, you measure some of your you measure all of your investments to some degree against the UN's Sustainable Development Goals. So what are your thoughts around opportunities that may have significant impact but potentially lower dollar returns?
So we look at targeting the same commercial returns that traditional VCs target. And with that, impact as part of that process. So we do think that impact has the potential to create outsized returns. And so the startups that we look at don't trade off the returns for the impact. And so there are some things we just know that we can't invest in through Giant Leap. So something like the issue of homelessness, for example, I don't know that we would necessarily be able to find a startup that would be able to generate the commercial returns that we need for our fund and for our investors in order to fund a business in that space. But I think that there are, impact investment is very broad and it's very subjective. So you'll talk to one impact investor and they'll focus on a certain sector or a certain area and have a different return profile to say Giant Leap or another angel investor. It just really depends on the individual. So for us, we do have to think about ensuring the impact and commercial returns are at that kind of, level which our expectations of our investors meet. So when we think about the potential for returns and growth, we always think about 10x growth, not to say probable, it's potential, because we know that a few of the startups will fail along the way. Some will return 1x, 3x, 5x, hopefully, and 10x. But having that risk and taking that risk on, there needs to be the commensurate potential reward with the market opportunity on the other side. So I would just say to these, founders that are thinking about that and their growth profile, whether or not venture capital is right for them, if they're not thinking about that scalability, because it may not be right to take on venture capital, and alternative forms of funding or private family offices, etc., might be better fit.
Yeah. Maybe there's an opportunity to do a quick promo for both Rachel and James. I guess, James, you've got the sister organization that Anna runs in Boomerang Labs focused on virtuous circle or circular economy and so on type investing with an enthusiastic group of angels. Rachel, you've obviously got your sister organization, the Impact Angel Group, which is full of angel investors, including myself, who have a motivation to invest in those sorts of startups. But for those that are on the line with a circular economy type investment or a circular economy type startup that are trying to work through the mechanics of business viability and so on, I'd encourage you to just Google those two organizations. Another question here from Prem Sundaram for the team. If a new startup is needed to do a pilot stage on a project where they've done R&D already, who do you think is the best type of investor to approach to reach this next stage? Does it have to be an angel? Does it have to be limited to a government grant? Which is the most likely opportunity? And maybe I might start with Eric on this, because the final part of the question is, Eric, is there anything you would do differently knowing what you know now with regard to funding your, I guess, early stages of the E2S pilot?
Well, excellent and very complex question. Where we started in the university sector, so we did have access to some government research type funding in the very early stages. But if you need to do a pilot that is at a commercial, how can I put it, commercial quality pilot, if you like, you do need outside funding. We we were lucky in that our development contract with the Swiss company actually, has funding with it. I'm not sure I would do anything different. What we've ended up with the Accelerating Commercialisation grant, mainly as a means of not giving away too much equity too early. So it's a non-diluting funding, as is the contract with the Swiss company. So we've managed to maintain a high degree of equity, and yet we have enough money to get on with what we need to do. Now, not everybody's going to have that opportunity.
Yeah, it's a very fair comment. When I look at my work with you over the last couple of years, I think that magic ingredient of the E2S contract, for those of you listening into this or watching this webinar, looking at how to fund your own early stage startups, where you have got some meaningful industry interest, is how can you turn that industry interest into some form of paid engagement? Because ultimately that's exactly what Eric and the MGA team have done. They've got a massive channel partner, to use the distribution language, in Europe, who's interested in representing them into the Europe and indeed other marketplaces, but starting Europe, and they put their money where their mouth is. They want to be actively involved. They have good financial backing, and therefore they've been able to back their enthusiasm to participate with a financial commitment. And that's obviously a beautiful statement that has facilitated the Accelerating Commercialisation grant, and it's unsurprisingly got the attention of a bunch of VCs. So a beautiful model there.
The final bit, are investors open to funding pilots? I would say there's no universal answer to that. But if there's an opportunity to leverage their funding, as we've done with Accelerating Commercialisation, that's good value for them as well. It doesn't, you're getting extra money into the company. You're not diluting the investors' equity either.
Yes. Yeah. Here's a very open question that I might throw at both David and then James. What are some of the Cleantech successes in Australia that have been supported by venture capital? Do you want to have the first crack, David?
Yeah, definitely. So aside from MJ Thermal, there's another great company emerging out of Newcastle in Australia called Diffuse Energy. So they're going after the, small scale wind turbine generation market. So another company that's raised a successful seed round. I can't remember off the top of my head what they raised. I think it was about $300,000 from memory. Might have been a little bit more than that. So another great company. Again, that was some technology that emerged from the University of Newcastle. So to speak to some of the, earlier questions around finding investors to take on that R&D pilot phase, my suggestion is, if you look at most successful investors, they typically don't take technology risk. They don't invest in anything where the will it work question hasn't been answered definitively. They usually only like taking on market risk, like will the product sell? So not saying you might not find an investor that's willing to take on technical risk, but that's sort of not a strategy to bank on. And so I guess in terms of, other successful companies besides MGA and Diffuse Energy that are at that seed stage, we saw a big investment by Grok into 5B Solar, sort of the modular solar rollout. So I think if you haven't seen that company, that's one to check out. Again, I'm not sure if the investors in Sun Cable are public, so I won't say their names, but I think Sun Cable has successfully raised a fair amount of capital, and given that's a large infrastructure project, that pretty significant amounts for that first raise. So I think that's another company that's successfully raised. I don't know if the investors in that are public or not.
They are indeed public, and for those of you wondering, it's Mike Cannon-Brooks, one of the founders of Atlassian, and Andrew Forrest's of Fortescue Mining fame, his private office, that are major investors to the tune of a few $100 million in the Sun Cable initiative. So it's a very, very exciting initiative that will develop a solar farm, a massive solar farm in the Northern Territory, and a large part of the output will power Singapore, a nice local initiative for them. Mike Cannon-Brooks thinks big. James, what are your thoughts? Any other investments that you're aware of, big successes of local clean tech startups that have raised good capital?
There are quite a few. Just to add to David's list, there's Amber Electric, one of our alumni who raised from the Giant Leap Fund, so Rachel can talk to that, but also some other VCs such as Square Peg Capital and Black Sheep Capital. But also, it's not just the VCs who are getting into clean tech startups in Australia. Angel groups, not just the ones that Impact Investment Group and Angelo run, but some of the mainstream ones like Sydney Angels are also increasingly investing in clean tech, particularly clean energy startups. And in just the 6 months, Angelo Angels has co-invested with some other angel groups like Sydney Angels in startups like PowerPower, Ping Services, and Sakona Battery Technologies. So there's quite a lot happening despite the impacts of COVID.
Indeed, and you've listed some good, interesting hardware-oriented startups there between the two of you. I can add one that's in the energy trading space that I'm quite close to, called Innosi. They enable residential and business consumers to basically buy your electricity direct from a solar and wind farm. Clever piece of energy trading technology. Here's an interesting question that relates to the going overseas or starting here piece from Ross Faisal. I might open this one for you, Rachel, if I may, first of all. Where a business is making good traction overseas already, has got lots of overseas take-up already, but none in Australia yet. What are your thoughts here about the importance of getting traction in the domestic market?
Well, it depends on where you're seeking investment from. So, you know, you might be better off seeking investment from the investors that are in the country where you've gotten the most traction. But again, having said that, you know, we've got a couple of investments in the US that don't have a presence in Australia today. And we were introduced because of our networks in the US and the impact investors we know over there. So I don't think geographical boundaries are limiters of your ability to raise capital anymore. It's just understanding the investors and going to what David said around understanding your investors and if they're right for you. I think that's a question, not necessarily anything around the details of where you are, where you've gained the traction. It's going to be dependent on the investors you're targeting as to where they might focus. So some of them can't actually invest in entities that are overseas. So one example of a limitation is we're an early stage venture capital limited partner structure, ESVCLP. It's a bit of a mouthful, but that means we can only invest 80% of our fund in Australia and 20% overseas. So there are limitations like that if you don't know the fund, you could be kind of approaching the wrong investors for you.
Yes, that's a great comment. I'm conscious that we're getting close to the hour here and have a limited amount of time remaining here. I've got a question here from Julia Reiser, specifically targeted at Rachel. Do you take R&D, I guess the question is, to what degree do you take R&D risks aboard when investing relative to commercial risks, particularly around clean energy?
So for us, it's much more on the market risk side, and we take very little kind of tech risk in the sense that we can only invest once we've already seen revenue being generated by the business. So for us, we don't profess to be kind of experts in any one space. We bring in the kind of expertise from our networks and really we understand markets and how to scale in markets. So I think that's the approach we take is not so much on the tech risk side, but more on the market risk. But that is because we really focus on, and predominantly software businesses because of the scalability. That's the mandate for this fund, where, we'll think about things probably differently with Giant Leap too. But yeah, that is our mandate, to focus more on market risk than tech risk.
Yeah. here's a common question that I hear a lot around startups trying to raise money through grants versus seed funding. And the common commentary, just to add to the question, is around the paperwork, the bureaucracy associated with completing grants versus, and to some extent, the speed or lack thereof in grants versus raising investment money. Eric, what's your perspective on the grants versus the VC or capital raising balance?
Compared with trying to get research grants in universities, obtaining commercial grants from government is a piece of cake. not in terms of just in terms of the amount of effort. They only want to know the important core of what you're asking for. They have a team of people who helps you complete the process in at least the New South Wales and the Australian government. Commercialisation Australia give you a commercialisation advisor to help you as well. We didn't find it particularly onerous, but then we have a background of putting in a 100-page research grant with a 20% chance of success. So it's a scaling thing. Yeah, so there was another question on the Valley of Death, which I suppose relates to this topic as well. So there are government grants to help you if you can't access, university funding or research grant type funding. But ultimately, you're going to have to dip your toe in the water and get some commercial funding from a commercial source. And VCs are probably the ones most amenable to conversations around that. It's hard to get in touch with a lot of family offices and other investors. So, it's definitely simpler dealing with a VC, but then they're going to dilute your equity. So,
yeah, indeed, it's a balance, isn't it? Really, we're very rapidly approaching the top of the hour. I think I've just got time for one very quick question and one very quick answer from you, Eric. The question from Ross is: what exactly is MGA made of?
Oh, okay. MGA stands for miscibility gap alloys. So essentially made from two metals that don't mix, basically, or a metal and a semi-metal that don't mix. That's all. It's very simple. So very simple materials. The complication is that you need to arrange them in a structure so that the metal with the lower melting point is present as particles embedded within the other material, and it can melt and refreeze when you heat it and cool it down, and absorbs and delivers energy in that way.
Yeah. Very, very clever technology. I think we're pretty much at the top of the hour here, so let me thank our panelists enthusiastically for your spirited conversation and contributions here, and also thank the questions that have come in thick and fast. Most enjoyed the participation of everybody here. So thank you, Eric, Rachel, James, and David. And let me hand back to Tiffany.
Thanks, Paul. Yes, we certainly had an onslaught of questions there towards the end. So thank you, everybody, for asking those questions. I've taken a note of them, and we will be asking the panel to follow those up, and we'll send out their answers to those in our follow-up communication, which will come out early next week. So just to reiterate, Paul, thank you to Eric, David, Rachel, and James. Great conversation, great questions, and we really appreciate you sharing your insights with us today. Just to let the audience know that our next Cleantech conversation, date to be advised, but it will be in early September, will be around hydrogen technology. We get a lot of questions about this in our webinars, so we hope we're pulling together a panel of experts to answer about investment, deployment, commercialisation, research, etc. So please look out for that. We'll be sending out those details next week. So thank you once again to our panel, and we look forward to seeing you at the next Cleantech conversation.